I love me a good intro. Where did you pop in from? It's magic. I like it.
You're not in just your TVs, your radios, nothing. It's late. I'm still up. I should be asleep, but you know what? Tonight is very, very important because we want to welcome you to Money Matters Building Black Wealth Series. I'm your co-host, Kelson from the AM Click. Check me out weekday mornings from 6 to 10. And then right behind me is my midday girl to take you through the middays.
Yeah, Persia, Nicole. I am here 10 a.m. to 3 p.m. Monday through Friday. We make lots of power moves every single day. I get you some brand new money, but tonight we're doing more than just that. So excited to be a part of this phenomenal event because we're going to build some Black wealth in our communities, and have two amazing panelists that is going to help us get there. So, Kels, you ready to build some money, some Black wealth?
And first off, we got to say special thank you to our sponsors, the Maryland Department of Housing and Maryland Department of Housing and Community Development, and also APGFCU. There we go.
Yes, we've been saying that all week. So listen here. And I love how Blake's right there. Let me just say we all have been on all of these Zoom calls. So us parents that are watching right now, we know my son will probably knock on the door in a few more minutes. But before that happens, let's bring in some amazing guests. First up, Liz Monti, representing one of our sponsors of the night, APGFCU. Hey, Liz.
Hi, thanks so much for having me.
Absolutely. So let's talk a little bit about you and exactly what you do.
I'm Liz Monti. I'm the Financial Education Director at Aberdeen Proving Ground Federal Credit Union, in case you were wondering what APGFCU stood for. I've been with the credit union for now since 2010, so it's going to be 12 years now. Love what I do. I actually put myself through college by working at a financial institution back in 1984. That's when I started. But the past 25 years, I've been in the credit union movement, and I love it. Last 5 years in financial education, which it has been such a blessing. Me being of Latino descent, first person to, actually not Latino descent, I'm born and raised in Puerto Rico, so I am completely Latina. So it meant a lot for me to be able to help others build their wealth, especially those minorities, because I know what it was like, right? So love what I do and love the opportunity to be able to share whatever I have learned through experience or through education. That's what I'm here about, to help people build their own wealth.
Nice. And that's very important. Our next guest for the evening is Mr. Gary Plummer. He's the Senior Home Ownership Advisor with HomeFree USA. Gary, how you doing?
Doing great, Kelson. Thank you so much for inviting me. Persia, thank you so much, guys. It's been a pleasure to come on. I count it an honor to be on this powerful empowerment session that's something that the people of our people need. And when I say people of our people, I'm not just specifically and especially pointing out just the Black community, the minority community, but all of the minority communities. Because you know what? One of the things that of my 26 years, and believe me, when I started out coming out of an HBCU, Bowie State University, let me make sure I make that plug.
Okay.
I started out as a management trainee where I made good coffee. But from that, I went to become a junior loan officer, senior loan officer, sales manager. And when they offered the buyout in the business after 26 years, I was a business development director. So I not only know the front line and how to get to the front line, but I've worked that front line. And I think it is so important. And I tell you, I got to testify that it's been my goal, my passionate commitment to close the racial wealth gap that exists in this country. And you see it over and over again, especially in the appraisal disparity that you see in Prince George's County. You've got to ask yourself over and over again, how in the world in the minority community is the values only raising 7 to 8%, but then you go over to Montgomery County and Fairfax County and you see it rising 46 to 51%. There's something wrong, or as my grandfather used to say, something in the milk ain't clean. So I'm glad to have this conversation that we're having tonight. Thank you so much.
You better come on here preaching then. Yeah. Come on. I want to dive right into this because I want to talk about the importance of good credit. You know, some people may say, I have cash. I don't need credit. I got money. Why is it, having good credit important? Let's start with you, Liz, and then pass it over to Gary.
Oh, I say if you have cash to pay for a house, to pay for your education, to pay for a car, to do your investments, absolutely yay. That's that's the most important thing. But unfortunately, what's realistic, right? Most of us do not have that cash to be able to pay for those things, to buy a house outright, to buy that car that we need to get to work, to pay for our education. Unfortunately, we do need to make sure that we have credit, that we establish credit, and not just establish credit, but that we establish good credit and good credit history. It doesn't just impact loans that we may get in the future, and everybody knows this here. It's going to impact if you can rent a house. It's going to impact your insurance rates. Is going to impact the opportunity for you to get a job. So credit is important.
All right, Mr. Gary.
That's absolutely the truth. You know, when we look at this and we understand credit, as CNBC pointed out just last month, that 93% of millennials know their credit scores because they're not only used to, but are very familiar with the app programs that are out there. So the knowledge is available to them. But when you stop and think about credit, you've got to understand what's so important that we have to teach. And that's not just financial literacy, but we've got to teach financial legitimacy, because it's easy to buy a home. It's so much harder to keep it. And until we help people to understand that when you're developing your credit, you've also got to develop an effective savings plan. Because if you don't plan to fail, you're going to fail to plan. And you're going to fail to plan if you don't plan to fail. But you understand what I'm saying? And I guess I twisted it up a little bit. But you know what? The worst thing in the world is to buy a home and be house poor. And I'm talking from experience, because when I first started out and bought my first townhome, I got to the point that after my first year, because all of my expenses, all of my focus was going to my house payment, I got to the point where I hated that home, couldn't wait to sell it, because I needed to be able to put myself in the right situation. So I think Liz would agree with me that we need to make sure that we focus and do everything that's possible to make sure that we bring the minority community up to where we ought to be, because the truth of the matter is the greatness is within us. We've just got to be able to bring it out.
One question I know a lot of people have when they're trying to buy a house, get a car, they may not know the difference between a hard pull and a soft pull. Can you explain those?
I can take that. You want to take it, Gary?
No, go right ahead, Liz, please.
Sorry. Thank you. Hard pull. That's when it actually impacting your credit. Is you're saying, I'm applying for credit. I want you to look into my credit history to see if I can get this loan. And it'll show an inquiry, a hard pull on your credit. A soft pull is really, it doesn't impact your credit. Maybe someone is looking to see what kind of credit you have for employment purposes. It could also be when you're getting a savings account or a checking account, the financial institution may do a soft pull to see what your credit is like. So those things are not going to impact your credit, while anytime that you apply for a loan, that's going to be considered a hard pull, and that's going to, or if you check for your own credit, that's going to be a soft pull and it's not going to impact your credit. Gary, do you want to expand on that at all?
I think you kind of hit it on the head, but a soft pull is a consultative pull, where we're not trying to sell you anything, but we're trying to give you proper advice, proper education, where we're trying to lead you according to the right guidelines. If you're on the platform or in the banking, in banking operations out in the branches, and they pull that, it's going to show as an inquiry. Because why are they pulling that credit? Because they're looking to sell you a service. They're not going to sell you a checking account if you've had a situation where you've had some problems somewhere else. So again, we've got to go and make sure they understand what a consultative pull is, but also that every American out here is entitled to one free credit report to understand where they are. And it's so important to know where you are, because if you don't know where you are, you will not have any clue on where you're going.
Speaking of that, if I do a soft pull or a hard pull, do I always lose points on my credit score, Liz?
So if it is a hard pull, it can impact your credit. For example, you go to a department store, and of course you're going to get a discount if you apply for the credit card. And you say, why not? You get approved, you get all excited, you get a brand new credit card. That may impact your credit, right? May not be that bad, but let's say you say, oh, this is nice. I can get credit cards from all these different stores and get all kinds of discounts if I do that. Now, if all of a sudden you have 5 different pools, hard pools from stores, from credit card companies, you're going to see a decrease in your credit score. There's also for mortgages, and Gary will probably expand on this as well. If you're looking for a home, it's okay for you to compare what different mortgage companies are going to give you. You just have to be very careful how many times and within what period of time, because if you do it within a 30-day period of time, it's not going to impact your credit. But if you have a lot of pools for more than 30, after over 30 days, then it's going to impact your credit score. So those are things to consider.
Okay, we got a question right here too. Let me head down to the question. What is the best way to repair your credit? And I was actually going to ask that too, because I want to know, as far as improving and building your credit score, what are some steps on how to first build it, or maybe even to improve it in some people's case? Some people feel like, the credit score is so low, it's really because they don't have anything on it, not because they have bad stuff. So let's talk about the building process, the improving process, and how to keep it good. Gary, you want to talk a little bit about that?
Certainly. You want to certainly work with someone that is a certified HUD advisor, someone that understands the credit pull, that understands the credit programs, but also understands the fact that a soft pull is never actually seen on your inquiries because it's not counted against you. Number one. Number two, you want to make sure of your inquiries and how many times you go out. That's why it's always good to work with a certified advisor, because not only is he going to give you the proper advice to make sure that the program that you're looking to try to get into is the right program that fits you. For all the years prior up until 2012, when the Making Home Affordable programs came out, and they actually started to look to make sure that home ownership advisors understood the programs, but more importantly, they were experienced in the mortgage industry. So that when you start to work on your credit, you've got to understand what credit balances matter, what changes the credit balances are. And you want to talk to somebody that understands how to get the settlements, what's good to be settled on, and that the fact that there make so many more changes, even with some of the medical bills that you see. So talking to an experienced advisor not only helps you get to the bank that's going to actually work with you. Stop trying to fit a square peg into a round hole, but find the right bank that matches your mortgage profile. Once you're able to do that and work with somebody to help you with your credit, they can not only review each one of your trade lines, and a trade line is like a Macy's card, an American Express card, your Visa card, but they're going to help you map it out, give you an action plan that works so that you can say, listen, this is your credit score right today is at 560. But based on the analysis that we've just run on your report, if you do A, B, C, and D, in 6 months, your credit score is going to be a 620 or 635. The systems have modernized themselves so much so today that we're now able to predict where we can put you at in 6 to 9 months, and hopefully to make you a homeowner, but also make you a responsible and accountable homeowner. Because as I said, it's easy to buy a house, so much harder to keep it.
We had a question here too. I want to see. There we go.
Charlie says, is it true that once you pass a credit score of 750, anything above that won't make any difference with your interest rate or approval? Everyone wants the magic 800 plus, but does it matter?
We all want 800. We all want that perfect score. Liz, you want to dive into that?
Okay, so it's going to depend, of course, on the lender. You're going to find that some lenders probably that is the magic score for you to get the best interest rate possible, or you may find that it's going to be a little bit higher. So I would say it is so extremely important just to make sure that we are managing our credit well. But I just cannot say, to get the best credit score is going to be 750 because the lenders are going to vary of what that number is going to be.
If you're just tuning in, welcome to how Money Matters, Building Black Wealth Series, being brought to you by Maryland Department of Housing and Community Development, and also APGFCU.
Another question right here at Lindley. Hey, Lindley, what if you're shopping for a car loan and applied to multiple banks? Does each one count as a hard pull and impact your score? That's nothing right there, because you do want to shop around for a good car. And so as we're shopping around, they're pulling our credit. What about car loans?
And I tell people this, especially my clients, all the time. If you're going into a car dealership, you should already have your credit established, your credit approval established before you get there. Because you've got to understand, when you go into that dealership, they're looking to not only make the deal, but they're also looking to make the money for themselves. Mm-hmm. And I can tell you nightmare after nightmare, story after story, where you've gone in there, and once that finance manager goes into the back and starts pulling that credit, you don't know how many times he's pulling. Mm-hmm. You just sitting there hoping and praying he's going to get you a deal. No, that's not the way you should do it anymore. And I tell people this all the time. Don't go into the dealership looking to do the financing through them, because they will pull your credit so many times, might get you the deal, but by the time they finish pulling your credit that many times, having that many people look at it, your scores could have dropped as much as 160 points over a one-night period. So I try to make sure that people understand, if you're going in to look at the car, let them know I'm in here to look at the car only, not trying to let you pull my credit. Protect your credit. That's how you get good credit and keep it. You've got to protect it and value it as it's your goal, because eventually your credit will be the goal that you need to accomplish the dreams that you have.
Mm-hmm. And I guess if you do want to apply for a loan, a little plug for Liz, APGFCU, along with the credit union. Gary, I want to go back to what you mentioned earlier. You mentioned the 3 credit reporting services.
Yes, sir.
Is one better than the other?
No, not really. But that's a great question to ask. It's not really. No, it's not. We're just so used to Equifax. And if you live on the East Coast, you'll notice that a lot of things that you've done on the East Coast might show up a lot quicker on Equifax and show up a lot later down the road on TransUnion. Why is that? Because TransUnion is reporting most of the time from the East Coast. So when you see something come up under TUC, that's TransUnion. Equifax is over here and Experian is in the middle. So a lot of times you might see your Equifax score a little bit higher if you've been performing well on all the rest of your trade lines. And the next score will come in will be Experian, and TransUnion will follow. Unless there's some mistakes that might happen. I always tell people, if I see TransUnion score higher and you live on the East Coast, we need to look at the trade lines, because something's not recording properly.
And also know that different financial institutions are going to pull different different credit reporting agencies. For example, somebody may pull TransUnion. East Coast may pull, Experian or Equifax, so it's going to be different, but it's important, as Gary had mentioned before, for us to monitor our credit and make sure that we're pulling our credit. As he said, in the state of Maryland, we're entitled to a free credit report once a year. We always recommend just make sure that you go at least every quarter, every 4 months to one of them, because they're all similar. They're all going to be very similar, to make sure that everything is correct in your credit report. You will go to annualcreditreport.com. Again, annualcreditreport.com. There's no need for you to put a card in there, no any payment information. If you do, you're in the wrong website. The other thing I want to make sure that everybody is knows is, because of the pandemic, there has been a lot of concerns about the credit and the finances. So the 3 credit reporting agencies are offering free credit report. You can check your credit reports weekly until April 20th of this year of 2022. So if you're concerned, you can go in once a week and until April 20th of 2022, and you can check your credit report. Perfect.
Okay, cool. We have another question, and I want to circle back to what you were saying about the you being in the wrong place, because we have to get into the scammers too, because everybody's kind of worried about beginning scams. Mm-hmm. But Glenetta on Facebook says, "Are apps like Credit Karma good, a resource? Because is that something okay for credit score?
Because we all have the app.
Yeah, we do.
So I think Credit Karma is good to gauge, right? It'll tell you, whereabouts your credit score is. If you need to work with it to get it higher, then where is that? So Credit Karma is a good tool to gauge your credit score and to see what's going on in your credit history. Usually lenders are going to use FICO score, so it's going to be different than what Credit Karma is providing. So don't expect what the lenders are using are the same thing that or is the same credit score number that Credit Karma is providing. Again, use it as a way to gauge where you're at, but don't expect that to be the right credit score that the lenders will be pulling.
Would you say that's the same as, different financial institutions? They'll say, check your credit score. Would that be the same as like Credit Karma, or you think it's more official?
So you can, I would go into annualcreditreport.com. There's a lot of, you have a credit card somewhere, a lot of the credit card company apps are actually giving you your FICO score. That's another way to look at it. But then again, keep in mind that when it's pulled by the financial institution, it may be different.
Let's circle back to what you were saying about knowing that you're in the right website or wrong. How do you know if you're actually in a credible place, somewhere that's not going to scam you and take your money, and you're just trying to get a score? What are some signs we need to look out for?
Well, I just think if you have to pay for it, if they're asking for your credit card information, you don't need to be there, because you can get it completely for free. So make sure that you're going to annualcreditreport.com. And you don't have to put any credit card information. You'll be in the right site.
Okay. All right. We got another question. Awanya, banks offer credit scores as well. Bank of America, is it the same, or should I expect that to be exact as well? Gary, you want to tackle that? Yeah.
I think Liz hit it hit the nail on the head when she said it. But we just need to be very cautious that those scores are going to be, because they're commercial scores that you're seeing. So they're going to be traditionally higher. In many cases, 35 to as much as 50 points higher. Once you run a tri-merge, which is a much more analytical report. And the reason that tri-merge is a lot more detailed is because that is the report that an underwriter is going to use. Yeah. So a lot of times I let people know right up front, please be aware of those Credit Karma. I'm sure you remember the jingle, creditreport.com. Those services, they advertise because they wanted your information, not because they're doing such a great thing of giving you the credit scores. But we're in a society now where data sells. Mm-hmm. And so they're gathering your information. And guess what? Once your scores get above 620, they're selling them to the credit card companies. So all of those letters that you're getting, once you see that your credit scores have gotten above 620 or so, Now you're getting in the mail advertisements that says, hey, listen, apply with us, apply with us, apply with us. They're selling that listing. So it's a good source, as Liz just once said, but be very careful. Be very careful of scammers because they're out there. And I mean, they're scammers that look very professional. They have even a government seal. But as Consumer Finance Protection Bureau puts on their website, and if you go to their website, you'll see, they'll tell you, don't be misled by credit report companies or credit repair companies that say you have to pay them first, because that's not the way the guidelines are set up.
Okay. One question I've always had when people are talking about credit and, you know, trying to get that credit score higher is this 30% rule. Can you talk about that, please?
Yeah. So one of the factors that affect your credit score is going to be the amounts that you owe. And that actually impacts your credit 30%, your credit score 30%, that much. So if you owe too much, if your utilization of your credit is higher than, usually they say 25 or 30%, you're going to see that there's going to be a drop in your credit score. So it's extremely important. And I always tell everybody, you know, credit is good if you use it wisely. And you have to make sure how to use it for wealth building. Credit cards is a tool. Pay off your credit cards monthly. And if you cannot pay them off monthly, make sure that you don't have a balance greater than 25% of what your line of credit is.
Okay. All right. So I want to redirect the conversation a little bit because I know the Maryland Department of Housing and Community Development has programs to assist home buyers, homeowners, and renters. Gary, can you talk about some programs you are familiar with that can help out? Because everybody wants a program to help out in some type of way.
The Homeowners Assistance Fund, or the HAF program, is that everyone is talking about, is actually an excellent program. The funds came from the CARES Act when everybody saw the law changed in March 2020. When the CARES Act came, it came to help people that were struggling with their payments, whether they were renters or homeowners. They were actually giving out grant money to help them. This HAF program that's out right now not only helped those that are struggling with their mortgage payments, but those people that are out there that are struggling with some of the winterization programs, your windows that might need to be replaced, legal services that you might need that extra fund to get the grant money from. All those programs are now available to Maryland homeowners. And I tell people all the time, take advantage of it. Take advantage of the programs that are available to you. You can get up to $30,000 in these grant programs. And all you've got to do is show that you were affected either directly or indirectly by the COVID crisis. And I got to tell you, almost all of us were affected by that confusion of COVID.
Yeah.
Liz, I have a question for you. I'll be real, everyone can't pay off their credit cards monthly. Mm-hmm. So why isn't paying just a minimum good enough?
Oh, you're going to be paying forever. Forever. And one of the things that I like that now is a regulation, it has been, I think, for quite some time now. They have to show you how long it's going to take you to pay off your credit card if you only pay the minimum, and how much less time it would take you if you pay extra. So if you have a credit card, make sure you look at your statement. It will show you, there's a table in there somewhere that will show you what you need to do to pay it off faster. And also, credit card interest rates are higher. How are we going to build our wealth if we're paying money for somebody else to grow their wealth, right? Very important. Credit cards is not a tool to me to build wealth. Buying a home that is within our means, and learning how to use it, investing, maybe even education. And I did see a question somewhere about education loans there. could be, because then all of a sudden you can actually generate more income if you have better education, right? That's what the hope and the expectation is. But we have to be very wise when it comes to using credit, because that's now we're paying money to somebody else and not using that money to grow our money and build wealth.
Dominique says, does consolidating your student loan significantly impact your credit score?
Okay, so that, I think that's a loaded question a little bit, because when you do consolidate loans, all of a sudden you're just going to have one loan, and it could improve your credit score, but that's not the point. There are student loans that are federal student loans. There are student loans that are private student loans. I never recommend for you to refinance your federal student loans privately, because there's some benefits if you have a federal student loans. For example, during the pandemic right now, what happened? You know, they didn't have, the student loans didn't have to be paid. That the interest, it was 0% for some time. If students were for lack of better words, smart, they would have paid on it because they were 0%, right? They would have just made sure that they paid down as much on it because it was 0% during that period of time. And that is, I think, is stopping pretty soon if it hasn't stopped already. So, you know, just talk to someone who's an expert who'll be able to guide you before you make any type of decision of consolidating your student loans.
Okay. So let's talk about really quick the credit score, since we're still on this. What does a credit union look for when someone applies for a personal loan in comparison to like a home loan? Because, you know, there's so many different things. You're applying for personal or for school or federal for school, whatever it is. What exactly are they looking for when it comes to those loans? Gary, the home side, let's talk about that. And we could dive into, you know, the personal loans as well.
For the mortgages, and I'm sure Liz would understand and agree with me that you've got to have the credit, you've got to have the capacity, which is the ability to be able to pay whatever you have, but you've also got to have the collateral, which is going to be the house that you're going to buy. That's got to meet that obligation. And last but not least, you've got to be able to show a history that you can do that. So you need at least 2 years of work history that you're doing. And a lot of people get this mixed up, that you can do 1 year of 1099 or self-employment and 1 year of W-2. No, there has to be a 2-year history of your work right there. So the 2-year history of work, please understand. A lot of people think that you can just buy with credit only. No, you have to have some savings aside, because the way the industry is set up right now, that when these realtors take you out, they need 1% of the sale price for you to be able to write that contract. You've got to have 1% of the sale price to write right then as the earnest money deposit. So in other words, if that house that you're looking at is $300,000, you better be ready to write a check for $3,000 at the time you write the contract. The appraisal is $550. The inspection is $400. So you're already at $4,000, and you haven't even started talking about closing costs. So when you're ready to buy a house, you've got to be able to talk with an experienced advisor to help you get things in order, help you get things ready to be able to step out there and do it. It's not like buying a loaf of bread. You've got to be able to plan it, budget, and go ahead and set your goals accordingly. Listen, I tell people all the time, nothing can stop a man or a woman with the right attitude to achieve their goals, but nothing can help a person with the wrong attitude in anything. So you've got to have the right attitude to step into making sure you accomplish your goals.
Yes, and in that order. Okay. You talked about a financial advisor when buying a home, but what about just somebody who just needs help with their finances? At what point in your career or a certain salary or whatever would you suggest getting a financial advisor? Because it costs money to get that.
Yeah, when you're in college.
Oh, okay.
Start then. Start as soon as actually, as a matter of fact, I think that the sooner you start learning about investments, because you got to think when you're in college, you got to think of what your return on your investment is going to be, right? Your investment is the college, and you got to figure out how much you're going to get after. you're going to find that a lot of financial advisors out there will be happy to sit with someone who is young and guide them through the process. And let them know, these are things that you should consider. One of the things that I love that our credit union does, we're very invested in financial wellness and financial education in the community. And we sponsor what is called the stock market game. Stock market game is offered through the Maryland Council on Economic Education. And students from elementary school all the way to college can participate in the stock market game, so they can learn all the ins and outs of investments with fake money, right? So and so that eventually they can learn how to grow their own money. So I think we don't have to wait until close to retirement for us to have a financial advisor. I don't think we need to have $100,000 saved up for us to go to a financial advisor. I think it's very important for us to start creating those savings habits and at a young age, and start talking to a financial advisor or planner sooner than later. So when the time comes, you may be able to retire at 40 instead of retiring late like me at 65 or later.
Yeah.
So going back to the college kids and, loans and everything, I feel as though I got when I went to College Park, because, they said you got to build your credit, get a credit card. And I got a credit card. I wasn't working. $300. I maxed it out immediately. Couldn't pay it back. What do you say are good ways for college students, especially, to try to build that credit? I know there's like secured cards or unsecured cards. What's the best way for that?
Okay, so if you do not have a parent that can guide you through that, for example, I have 7 kids, and when it was time, I co-signed with them for them to get a credit card. But was I on it with them? I helped them manage it, and then they were able to establish the credit. But the best and safest way is to do a share secure credit card or a share secure loan. If you do that, you're using your own money and you're establishing a credit at a way lower interest than you would if you have something that's not secured or collateralized. Usually it's going to be like 3 or 4% above whatever your savings account may be paying you. Depends again on the financial institution, but it will allow you to establish the credit that you want faster. But I am more of let's first make sure that you learn how to budget, how to live within your means, that you understand that, and how to save, and then we're going to talk about credit and how you're going to be establishing that.
See, that's why it's important to have conversations like tonight, because I feel like in our culture, in our communities, we don't teach enough about budgeting and how we should do this and how you're spending your money and what your credit should be looking like. Like, it definitely needs to be taught more in the school system, but it starts at home. So, this is why it's great. And I hope that your kids are also tuning in with you as we're having this conversation tonight. I want to talk about how do you even know when you should get like a 36-month or 84-month loan when you're buying a home or a vehicle, because they don't teach you stuff like that in school. So when I first bought my car, and I was like, I don't know how long I want this to be. Like, you kind of go for whatever makes your payment lower. But does that hurt you just for going for whatever makes your payment lower? How do you know which months to go with?
Okay, so it's going to be based on your pocket, right? So the recommendation is always try to get if you have to get a loan, my recommendation is always save for your auto. And if you can, buy used. Although right now the market is so crazy, I don't know. The used cars are way out there. But ridiculous, usually on the normal market, I would say save, buy used, because why? Vehicles depreciate, right? And that's not going to help you build wealth, right? One of the things that we see common with millionaires is they buy used vehicles, because that's an investment, is for them to go from point A to point B. Also, you finance it for, the higher the interest rate is going to be. usually. So you got to keep that in mind. Individuals are going to finance it for longer because they think, I'm gonna get the lowest payment possible, or because maybe somebody that you, when a car dealer, thought, how much can you afford? $250 a month. Oh yeah, I can do that. You don't ask interest rate. You don't ask how long you're going to be paying for that. You don't ask any of that. Very important for you to know your credit. And I think Gary touched on this already. Make sure that you do know your credit before you go shopping for that vehicle, that you know how much you should be paying based on your credit, and that you have an opportunity to negotiate for what you're going to be paying for that vehicle. If you know your credit, if you manage your credit well, you have the upper hand. You actually you can save a lot of money because you can decide where you're going to go and how much you're going to pay.
And you can walk in the building like a boss.
You know what, Persia? Let me just say, I think Liz sounds like she's a wonderful mother, and I feel kind of rough because as a father, I've raised mine to believe this one thing, that you should train up a child in the way it should go, not walk but out my door. So in other words, I can't have them trained up to go if I haven't trained them how to properly budget. You've got to be able to take those young people and sit them down and say, this is how much you got this month. This is your expenses. Because you ain't a man until you don't need a loan. You ain't grown until you do not need a loan. And that means from me. So you show them this is how much money you got coming in. This is what you've got expenses. So if you see that you don't have enough, because I didn't co-sign for any of my kids, but every last one of them has a score better than 700. Why? Because you taught them to be accountable, reliable, and what else? Responsible. So once you teach them those 3 points and let them know you've got to learn how to stand on your own. And once you're able to show them how to budget that money and make that money work for them and not work for the money, that's when success starts to come. Because success is always in the perspective that the power that is in you. You've got to believe that, and you've got to walk that way and believe that way. And once you're able to do that, you're able to say, you know what, it's not how I started. Because just like Kelson, I went out and got a credit card, and then while I was at college, somebody told me come down to the hallway to the phone. That's all. I'm showing you how far back I was. We didn't have phones in our dorm room. The phones was at the end of the hall. I go down to the end of the hall, and the guy's calling me saying it's time to make a credit card payment. I didn't have a job. I told him, I don't know how you gonna get the money, brother, but it's not coming from me. I'm barely eating. So they made the mistake, and I think they still do it, to be honest with you, Kelson, is giving these young people credit cards, and they're not prepared mentally to be responsible. That is so important to learn how to do that. And we've got to learn how to teach them from a very young age. And I think that's so important to do that. And let them know nobody's out there going to help you. You got to learn how to stand on your own and walk on your own.
Yes, train them up.
I know a lot of folks are looking to, purchase homes, for their families and things like that. And I didn't realize this till I purchased my first home in 2018. Right. It's cringy because, they got to check everything, like all these different bank accounts, and you got to have this together. Can you go through and explain some of the things they're looking for and why it's important that have your money in order and don't keep dipping out of your money?
That's a great, you know what I tell people all the time, when you're in the business, I can look at your bank statement and I can tell you that whether or not you have a good an effective savings plan, or you need to have one developed. I can tell you how many times you go into Marshall's, Popeyes, and everywhere else, and that you don't have your budget in place simply by looking at your bank statements. That's why an underwriter wants to look at that, because your bank statement and your credit report is going to tell me everything about you that I need to know, all the way down to what your debts are, how you regulate your debts, and whether or not you're going to be able to handle a payment like this. That's why you have what's called payment shock. So you've got to be able to not only help people understand what the budget is, but you've got to now also teach them guess what? You paying your other creditors, you better learn how to pay yourself as well. Don't work for just them, but work for yourself. So every payday, pay yourself and pay your bills. And make sure that your debts to income ratios don't go above 50%. Real simple math. This is how much you bring home. 50% of that is going to go to your debts. If you can make 20%, now you're sitting in the driver's seat. But at least put 10% every pay period in the bank for your savings. I tell people all the time, your goal is 20% of every paycheck. But if you can do 10 and in 6 months look back, you'll be able to say, I've accomplished something. And now it's going in the right direction.
Yeah.
And Kelson, if I may add to that, there are a lot of home buying workshops and seminars to help people prepare for what a lender is going to look for when you're purchasing your home. Because like you said, it can be very overwhelming. So, it may be that usually the lender is going to look at 2 years of history. They're going to tell you, make sure you're not switching jobs once you have applied for your mortgage, because that can make a big difference. Don't charge anything else. Don't be applying for any new credit, because it's going to cause all kinds of consequences while you're going through everything. So I think it's so extremely important for us to educate ourselves before we go through the home buying process. As much as possible. And I usually recommend, if you think you're going to be shopping for a home 12 months out or a year, next year, start looking at what you're going to need for applying to apply for that mortgage and how you would prepare for it. Because also, as Gary knows, there are so many different mortgage products out there, and you got to also see which product is going to be best for you. And you want to make sure you know the ins and outs before deciding and applying for one.
Yeah. Since we're talking about dipping in money and things like that, a lot of people may say this is better or this is better, but do you think it's better to borrow from your 401k or to get a loan if you need money for something? Look, I see your face, Liz. You're like, don't do it. Don't touch 401k. Don't touch it. But some people say, well, it's my money. I'll just pay myself back. But other people say, oh, so what would you think?
Okay, so one of the things to consider when you're dipping into your own money, it is your own money, it's your 401k. First of all, now you're taking away from the money that you could be earning in the investments. Second of all, if you lose that job, guess what? All of a sudden you have this large sum of money that you're going to be responsible for paying. Right. And not only that, you may have a 10% penalty because you tapped into that before the age that if you're under a certain age, that before the age that you were supposed to. So usually the recommendation is try not to go into your 401k at all if you don't need to. If you manage your credit well and you have a good credit score and you have a good debt to income ratio, and I don't think we've explained, what that means. If you owe less, if your gross, usually we're looking at 40% of your gross, your debt to income ratio should be no more than 40%, 44%, something along those lines. Then you'll be able to get a personal loan for some financial institutions go as high as $50,000 for a good rate. I've seen some that are as low as 3.99, 5.99, 8.99, and I've seen some that are in their 20s. So weigh everything out, sit down with a financial coach to see what's going to be best.
I keep hearing us throw around good credit, great credit. Can we break down what is good credit? Like, is it 600? Is it 750? Like, what's good credit?
Liz, you want me to jump on it or you want to take it?
Go ahead, Gary.
One of the things I think is so important that you link up with an experienced and a HUD certified advisor so that they can not only point out the credit scores, but also the advantages to having a certain credit score, because 660 and above, you're going to be able to get most of the lender grant programs that are out there. And they're lender grant programs of people with a 660 score or better that you can get a grant that has your closing and your down payment up to $20,000. In Baltimore, they got programs that you can stack on top of the other to the point that you're coming to the table with very little to sometimes, in some cases, almost no money. One of the things that we do, our webinars, and we work with many of the banks in the area with their webinars and their home buying seminars to help people to understand that you might not have all of the money saved, but if you've got at least a 620, and I know FHA says that you can buy a home at 580, but you better have all the money to go with it to pay the down payment and the closing costs and whatever the rate's going to be, because if it's 580 or more, that means you've got some credit issues as well. And you're going to have to pay for that with the interest rate. It's going to be much higher because it's a higher risk. But if you've got a 640 to 660, you're okay. 660 and above, you're getting better. I tell people all the time, if you're 675 or better, that's when the lenders out there need to be fighting for your business.
Okay. All right. Liz, I want to get into businesses, banking. For those people building a business and need some cash management tools, like maybe merchant services or payroll processing, what are some other tools that are offered over at APGFCU?
Great question. Our credit union just started offering business banking services, and I am not the business banking expert right now, but we do offer business savings checking accounts. We do offer business loans, and I believe we are offering some merchant services. But one of the things to, just like you should with any financial institution, make sure you've determined what are my needs. What is it that I need to be able to run my business effectively, and compare what financial institutions are offering. And once you have that financial institution that you like, make sure that you develop a very good relationship with them. Stay with them. There usually will be a business banker that is going to be working with you hand in hand to try and help you meet the goals. But at our credit union, we do offer great business savings, business check-ins, business loans. And I would recommend either you check out our website, or feel free to contact me at lmonti@apgfcu.com, and I'll connect you with the right person to guide you through the business banking services.
I do have another credit question, because things I've thought about also, and as you're going through the years, you try to improve your credit. Why should you never close an account? Like, pay it all but never close it. I've heard people say that.
Great question. One of the factors that impact a credit score is going to be length of history, right? So that's usually around 10% of your credit score. So usually the reason, and that's about 15%, I'm sorry, of your credit score. So one of the reasons we recommend that you do not close that credit is because with that, now you're closing the history, and lenders want to see what your history, your good paying history has been. Don't close that credit, pay it off, keep it at a zero, but keep that history in there intact, because otherwise it can actually, when you close it, it can actually lower your credit score.
Okay.
All right, so we have about like 5 minutes left. This went by so fast.
Yeah.
I know. I'm so surprised.
I was looking at the time. I was like, wait a minute. And I want to kind of backtrack, because Gary talks a lot about this, and I thought it was very, very important, because when it comes to your children, setting them up for, a financial future and building the Black wealth, that's what it's all about. And Liz, the same thing for you, setting your kids up as well. What are some things you would suggest to help families build wealth together in their households and setting their kids up for wealth as well? Gary, let's talk a little bit about that, just in case people kind of chimed in and they got in late and they missed some of it.
I think, first of all, that you've got to teach financial budgeting. You've got to teach savings. You've got to develop a mentality to save. And because that's not something that most people find easy to do.
Mm-hmm.
But once you have that mentality to save, you're going to be able to put that money away and add to it, knowing that you've got to go, knowing that you're goal focused. Secondly, you've got to teach budgeting. You've got to teach budgeting because, unfortunately, especially in the minority community, financial literacy was not pushed, was not taught the way it should have been. Because the truth of the matter is, and I'm just going to say this the way it is. The truth of the matter is, we should be signing a lot of the checks in the small business arena, especially in the DMV area, and that's just a fact. And had we been able to teach that had we been able to teach it in the 70s, and I'm just giving you what I believe to be a fact, and I've spoken at several other symposiums. Had financial literacy been taught in the 70s and 80s, gentrification would not have come to DMV. And that's just a cold hard fact. And I think that we need to understand now that until we start making up our minds that we've got to now start establishing the foundation on where we're going to go in 2030 and 2040. Until we do that, that old saying, nobody's going to help us but us, we're going to miss the boat again.
Charlie says, speak it. I know that's right.
and talking about finances shouldn't be taboo in a family. So many times as parents, we do make the mistakes of thinking, I don't want to worry the kids about this and I don't want to worry the kids about that. It's very important to talk about finances as a family, to discuss what the budget is for the household as a family so they can see the different areas of what's happening in the household. It's okay to take them grocery shopping and say, okay, we have $10 that we can allocate for extra things, but not more. And then have them select what those things may be. We always try to, when they're little, we always try to instill the concept of saving, spending, and sharing. And we call that the 3 S's, with that, making sure that they learn the importance of savings, how to spend money wisely. That's why we usually may say something like, okay, you can earn income by cleaning the house. Although in my household, it was like, no, that's your responsibility. You take care of it. I'm not going to pay you for that. But, you to give them certain jobs so they can earn a little bit of income. Then from that money, they can decide how much they're going to put away for savings, how much they can use for spending, and what they're going to use for sharing. And everybody's going to have their own concept about what that's going to look like. When they're little, you can go with that 50-30-20 concept, or you can go with, you can decide 33-33-33. Whatever you decide, is just teaching them the importance of saving, spending money wisely, and sharing. I think that's a good way to start, and having those conversations is very important for the family.
So as we wrap up, are there any sites that has worksheets or, ways to build your credit that we can tell listeners to log on to and check out?
Oh, please check out our website. All kinds of resources at APGFCU.com. We have a financial wellness platform with all the topics completely for free. We're not going to be marketing to you. And you can use the website completely anonymously. So please check out also the free webinars we may have, and any additional resources that we have right on our website.
And of course, HomeFree USA. If you'll go to our website, homefreeusa.org, we not only have the TransUnion dashboard that you can go there and help budget yourself, but we also have FinLocker that works with Equifax. They help to not only help you to understand your budget, help you to put together a budget, but it also allows you to regularly look at your credit score, regularly set up goals on what you need to do, what steps you need to take to increase your scores. Because at the end of the day, you're the one that's going to make the difference. You're going to be the change maker in your life.
Yes, change maker in your life. We are building Black wealth around here. I feel like this whole time I've been like taking notes, like mental in my head, or I'm on my laptop, like right here, trying to add in different things. So I hope that everybody, I saw you over there writing too. I hope that everybody really got a lot out of this, because I think one thing this pandemic has taught us all is how to build wealth, how to build businesses, and kind of keep it here. In conversations like this, we have to continue to have. So I look forward to more conversations as well with you too.
It's been a pleasure. Thank you so much for inviting us.
Thank you. And special thank you once again to our sponsors, Maryland Department of Housing and Community Development, and also APGFCU. Thank you. I'll see you in the morning, 6 o'clock a.m. click. Good night.
Right after him, 10 a.m. Have a great night. See ya.